Picture this. The world's biggest debtor, the United States, turns to its closest ally, Japan, and says, "Wreck your economy, or we'll do it for you." Sounds like a wild conspiracy, right? Except it's not. It's U.S. foreign policy in 2025, playing out behind closed doors. Japan's already on its knees. Toyota just got slammed with a $1.3 billion loss in 2 months, and their GDP is shrinking fast. Now, Washington's demanding Japan crank up interest rates, even if it means blowing up their entire bond market. Why? Because the U.S. trade position is crumbling, and they're scrambling to save their own skin. But here's the kicker. Japan's not just sitting there taking it. They're gearing up for a counter-move that's got Washington blindsided. If you're fed up with surface-level headlines and want the real story, the geopolitics, the raw numbers, the sneaky power plays, you're in the right place. What's about to go down isn't just another trade spat. It's a seismic shift that could shake up global markets, rewrite alliances, and even threaten the dollar's reign. So buckle up, hit that subscribe button, smash the like, and let's unpack this story you're not supposed to hear. Because when this domino falls, it's not just Japan or the U.S., it's global. Imagine getting a call from your biggest ally saying, "Crash your economy, or we'll do it for you." That's basically what Washington just told Tokyo behind closed doors. Japan's already in a rough spot. Its GDP is shrinking, and Toyota alone bled $1.3 billion in just 2 months. Now, the U.S. is twisting the knife, demanding Japan hike interest rates, even though that could blow up its bond market. Why? Because America's trade position is crumbling, and they're desperate to offload $22 billion in long-term debt that investors are starting to dodge like a bad Tinder date. The U.S. Treasury's latest report practically orders the Bank of Japan to tighten policy and prop up the yen, even though Japan's already in a recession. This isn't friendly diplomacy, it's economic arm-twisting. Japan's debt-to-GDP ratio just hit a jaw-dropping 261.3%, the highest in the developed world, per the IMF. And yet, Treasury Secretary Scott Bessent is pushing for rate hikes that could tank Japan's financial system, especially as it's just getting out from a decade of yield curve control. It's like telling someone to jump out of a plane without a parachute. But here's where it gets spicy. Japan's not just rolling over. Tokyo's cooking up a bold counterplay that Washington didn't see coming. Instead of caving, Japan's eyeing a move to open the CPTPP trade bloc to both China and Taiwan. That's not just a trade deal tweak, it's a straight-up challenge to U.S. dominance in Pacific trade. Talk about a plot twist. Meanwhile, Toyota's getting hammered. Trump's 24% auto tariffs have obliterated their profits, down 180 billion yen, with a projected 20% earnings drop this year. That's over $1 trillion in operating income gone. Poof. Nearly 20% of Japan's exports go to the U.S., so you'd think Washington might ease up. Nope. They're tying any tariff relief to Japan, tanking its own currency advantage. It's like saying, "We'll stop punching you if you punch yourself harder." And then there's the bigger question. What happens if America can't even sell its own debt? The U.S. is about to test the waters with a $22 billion 30-year bond sale. This isn't just another auction. It's a global gut check on whether markets still trust U.S. solvency. Domestic buyers are already bailing, dropping to 14% participation from a 6-month average of 17%, according to the Wall Street Journal. Investors are being asked to lock in 5% yields, while the U.S. deficit is set to balloon by $2.4 to $2.6 trillion, thanks to Trump's stimulus plans. Inflation's creeping up, and Washington's acting like fiscal discipline is a foreign language. This isn't just a trade spat, it's a high-stakes game of economic chicken, and both sides are flooring the gas. Imagine you're Japan, one of the biggest holders of U.S. debt, and your so-called ally, the United States, tells you to torch your economy to prop up theirs. If you don't, good luck selling your cars or keeping your markets stable. That's the reality in 2025. And if foreign demand, especially from Japan, Stop soaking up U.S. debt. We're not talking a regional hiccup. We're talking a global financial earthquake. A failed Treasury auction wouldn't just spook markets, it'd scream to the world that Washington's debt-fueled empire is losing credibility, even with its closest friends. So, here's the big question. When faith in the dollar no longer buys loyalty, who's left to step up? In its June 2025 exchange rate report, the U.S. Treasury didn't mince words. They told the Bank of Japan, BOJ, to tighten monetary policy and force the yen to appreciate, all in the name of some vague structural rebalance. But BOJ Governor Kazuo Ueda isn't playing ball. He's sounding the alarm, pointing out that Japan's household spending is already tanking, down 0.1% year-over-year in March 2025 per Japan's Ministry of Internal Affairs. Sure, a stronger yen might make imports cheaper, but history shows that juicing up your currency during a downturn doesn't exactly spark a shopping spree. Inflation's above the BOJ's 2% target, but it's not because people are buying too much. It's fuel and food prices driving costs, not a booming economy. Here's where it gets wild. Deutsche Bank says Japan would need a 20 to 25% yen appreciation just to hit the U.S.'s trade balance goals. That kind of jolt would gut Japanese exporters, who are already limping from Trump's tariffs. But U.S. Treasury officials, led by Secretary Scott Bessent, are doubling down, calling it essential for bilateral balance. Whose balance exactly? Because at this rate, Japanese manufacturers like Toyota are fighting for survival, not fairness. And it's not like the U.S. has its act together. The trade team in Tokyo, Bessent, Commerce Secretary Howard Lutnick, and U.S. Trade Rep. Jameson Greer, is reportedly a mess. Bloomberg says negotiations hit a wall because the U.S. side can't stop bickering among themselves. Japanese officials are tearing their hair out saying they can't negotiate when the U.S. changes its stance every meeting. This isn't diplomacy, it's chaos. To Tokyo, it feels less like a serious talk and more like a performance for Trump's domestic crowd, grandstanding, not problem-solving. While Japan's trying to make sense of the mixed signals, those same U.S. negotiators are jetting off to London to meet Chinese envoys. Good luck with that, if Washington can't even play nice with its allies without turning talks into a battlefield. How's it supposed to handle a full-on showdown with its biggest rival? Japan's not waiting to find out. They're moving fast to shield themselves from U.S. volatility, doubling down on CPTPP markets to diversify their trade. This isn't just a trade dispute, it's a global power shift, and the fallout could hit markets, alliances, and the dollar itself. Stick with me, because this story's only getting started. According to Japan's Ministry of Economy, exports to CPTPP countries surged 13.4% year-over-year in the first quarter of 2025, led by booming vehicle shipments to Mexico and Canada. Toyota and Honda are now ramping up capacity in Guanajuato and Prachinburi, not only to sidestep U.S. tariffs, but to rewire supply chains through the zero-tariff corridors embedded in the 12-nation pact. Meanwhile, Bloomberg reports that Mitsubishi Materials is securing new rare earth supply chains via Vietnam and Australia, leveraging harmonized rules under both the CPTPP and RCEP. Tokyo isn't begging Washington for relief. It's building an exit ramp. But here's the real question. Can this pivot truly replace the scale of the U.S. market? Or will Washington retaliate even more aggressively once it realizes what's happening? Right now, global sentiment toward U.S. long-dated debt is deteriorating faster than Washington can adjust its fiscal forecasts. On June 8th, the Wall Street Journal reported that 30-year Treasury yields spiked to 5.12%, the highest since 2011. Traders are now calling it a silent boycott by foreign institutions. Why? The last auction revealed a 31% drop in non-U.S. demand, led by sell-offs from Japanese pension funds. According to Nomura, these funds are shifting into euro-denominated infrastructure bonds to escape the volatility of the U.S. dollar. Meanwhile, inflation expectations, measured by the spread between Treasury inflation-protected securities and nominal bonds, have climbed to 3.1% over the next decade, well above the Fed's 2% target. This isn't just a pricing problem, it's a trust problem. When foreign investors begin believing that U.S. inflation will consistently outpace bond returns, they're not merely questioning the economy, they're questioning the credibility of U.S. fiscal management itself. So what happens if the world stops viewing America as the anchor of global stability? Trump's 2025 tax plan is projected to add between $2.4 trillion and $2.6 trillion to the federal deficit over the next decade. The Congressional Budget Office warns that if current tax cuts are extended, U.S. debt to GDP will exceed 121% by 2033. Simultaneously, the U.S. is running a current account deficit of 3.8% of GDP, requiring a constant inflow of foreign capital simply to keep the dollar from sliding further. But here lies the contradiction. Washington wants to reshore production and reduce reliance on global supply chains while still depending on foreign capital to fund its debt. The Peterson Institute calls this an economic paradox. You can't bring everything home and keep the dollar strong unless global investors continue buying your debt. If they don't, the U.S. risks either a currency collapse or a debt spiral. Yet Treasury Secretary Scott Bessent insists that U.S. bonds remain the world's safest asset. Is that genuine resilience or denial in broad daylight? Inside Japan, the mood is shifting. A Reuters poll in May 2025 found that 68% of Japanese institutional economists now oppose rate hikes until trade policy stabilizes, warning that tightening too soon could spark massive volatility in Japan's own bond market. Privately, Bank of Japan officials are already floating a delay in tapering government bond purchases beyond the fourth quarter after 10-year Japanese yields climbed to 1.26%. Their highest level since 2013. But Japan's shift runs deeper. Behind the scenes, Tokyo is drafting contingency plans to admit Taiwan into the CPTPP, a move that could redraw regional trade routes and provoke backlash from both Beijing and Washington. Japan is signaling that it no longer intends to serve as a passive outpost for U.S. monetary ambitions. But if Washington insists that yen appreciation remains non-negotiable, this dispute could escalate far beyond tariffs, interest rates, or deficits. So here's the real question. What is Japan willing to risk to reclaim its economic independence? And here's the wild card. What if Japan doesn't just resist U.S. pressure, but starts rewriting the global trading system from the inside out? Think about it. China is circling the CPTPP. Taiwan is knocking at the door. The U.S. is tangled up in its own debt crisis. And Tokyo may no longer feel like it has to ask permission for the next move. If America loses Japan as a financial co-anchor in Asia, the consequences won't stop at higher bond yields. It could fracture alliances, redirect rivers of capital, and redefine how global trust itself gets priced. So we'll leave you with this. If Japan walks away, who replaces it? And what if no one can? Let us know your thoughts in the comments section below. We really appreciate your feedback. And if you enjoy our content, hit the like button, subscribe to our channel, and press the bell icon so you never miss an update. See you next one. Thanks for watching.